Igor, from an investor standpoint, why does the metaverse look like a disaster and Gen AI look promising?
Well, today it seems like a no-brainer to see why the metaverse has failed, whereas Gen AI has transformed or is currently transforming the economy. But from the time actually when the metaverse was coming out, there were some people that were very skeptical for good reasons, but there was also a lot of excitement. And there was this tremendous hype that was created, especially by Mark Zuckerberg's announcement to go into the metaverse. He basically did a multi-billion-dollar bet on this new technology, and other brands, all of them followed, right? And this is something a little bit comparable to AI in terms of the hype, because we've had tremendous media interest in the topic. Everybody's speaking about it. Companies were investing a lot in it. So every major company was in the metaverse, was selling NFTs and then raising capital. And there was a tremendous market also in terms of end users or retail investors that were buying a virtual land and stuff like that. So you can say in terms of hype, it was comparable to Gen AI. And it was also, of course, a novel technology with reportedly huge potential. But there was one critical difference. And I think this is the gold standard always in any technology when you're trying to judge it is this really a technology that is productive at the end of the day? And productive can mean a lot of things. It can mean, can you do stuff you're doing more efficiently? Can you do new stuff? Can you bring down the costs of something that you're already doing? Can you increase the speed? And actually AI, if you look at AI, it's excelling at all of those things. Whereas the metaverse, nobody actually knew what we needed it for, right? There was a huge discussion, why do we need the metaverse for? And there were many ideas and many visions, but nobody could actually tell you why you should spend time in the metaverse. Now, judging the productivity, of course, is always very, I would say, subjective matter. Everybody is assessing this from his or her own experiences and beliefs. But there are objective metrics, and perhaps the most important metric that you can have is adoption. And if you look at AI, it took ChatGPT, even as one application, it took it just 1 or 2 years to bring the whole technology into the very big mainstream market, whereas the metaverse just had no users. Let's put it like this.
Well, as we previously discussed on previous episodes, it was something that gamers were already doing, and Roblox was doing that really successfully. And gamers had a really cool and like pretty good looking metaverse already. And Mark Zuckerberg's pretty crappy in comparison. So it didn't really make sense.
It was looking crappy, even his own avatar had no legs when he was playing poker in the metaverse, and people were asking, why do we need this, right? Is this if this were some kind of killer video game, maybe there would have been an argument to be there, but there was no adoption. And there were reports that actually Mark Zuckerberg was trying to force his own employees to spend time in the metaverse. And if you have to force your employees to go there, those people who are very working on this project, then this is actually a very bright red flag. And if you look at the numbers, it's just even more sobering. Mark Zuckerberg reportedly burned through 100 billion US dollars with this metaverse idea. And at the climax of the metaverse, Horizon World, which was Facebook's metaverse, they had like 900 daily active users, for $100 billion investments. The other metaverses were not doing much better. If you look at Decentraland or Sandbox, which are decentralized variants of the metaverse, like those initial metaverse proponents were envisioning it, they were doing much more poorly, or just as poorly as Horizon World. They were not doing poorly in terms of investment, right? As I said, they were $1 billion in market cap. People were buying virtual land. Some were paying up to a couple of $1 million for virtual parcels of land that, sure, they cannot be copied within one metaverse, but, there were just many of those metaverses, so you could basically just move to another one if one got too expensive. So it didn't make any sense. So adoption is really the key, and you can track adoption by looking at productivity, as we discussed earlier, but you can also look at other things like where is the money going to? Because with ChatGPT and the metaverse, we had both a parallel that there was so much money going into the space, but the targets were different, right? With AI, it was more going in the beginning towards the application layer, later, of course, in turn to data centers and infrastructure. But if you look at the metaverse, most of the money was not going to build new applications that people wanted, but it was actually going into buying virtual land, which was highly speculative, right? So people were investing not so that gets better or because there is utility value, but simply because they were hoping that they can resell it to somebody else at a much higher price, which, tells you that this is a setup that will not work in the long run.
I mean, that's one of the criticisms that people have of cryptocurrency, but we will not go down that rabbit hole because then that will be a completely different episode. So you really focus on figuring out how to get the next wave of tech investing right. And so when we're talking about this, it seems that we're already talking about a fairly late stage decision, right? Like we can assess ChatGPT or Gen AI and the metaverse because these are already established technologies. People can already see the results. And so then you can make the decision, making the decision now is a fairly late stage decision. So would the same kind of methodology really apply to much earlier technologies or technologies that are still in the making, let's say like quantum computing?
Yeah. So it depends how early we're talking about. So it was, I believe, you would have been able with this methodology to catch the AI boom, for example, much, much earlier, right? And we can actually put concrete figures on this. So there's something called the technology adoption lifecycle, which basically tells you, there's different kinds of groups of people or segments of the market have to address. So first you start with the visionaries, then you get the pioneers, then the early majority, late majority, and the laggards. And there is a critical point in time with every technology where there is a chasm in which many technologies fall and don't recover. And if they pass this, the likelihood is extremely high that they will be successful in the end. And this occurs usually between the shift from early pioneers, and also not pioneers, but early adopters and the early majority, right? So this is somewhere between 15 to 20% of the markets. For example, this would have given you a very strong hint to get into this technology already a year after ChatGPT launched. So, of course, you wouldn't have been able to foresee it, but you would have still caught a tremendous steep growth curve. Now, if you're asking me about even earlier technologies, what we don't call emerging technologies, but frontier tech, there is a possibility to gain like 1, 2, 3 years of advantage to this overall market. Of course, that's always a very risky game, but it's possible. And there are a couple of indicators that you can track that I also discuss in my book. One of them would be, for example, to look at the number of patents, right? How many patents are filed in a certain technology, by which companies, in which regions, for another possibility would to look at the interests, media interests, but also interest in terms of the people that are hearing about this technology, which you can track with things like Google Trend scores. Then there's even the category of scientific papers, because if you look at big technologies, and blockchain is one of those, if you had tracked blockchain scientific papers, you would have beaten the market 2 to 3 years in catching these very steep growth curves. And finally, one of my favorites is the talent trends, right? So you can, for example, look at where are the people going, right? So if you look at AI and what we've seen over the past 10, 15, maybe even 20 years, there was a steady shift of AI PhDs from academia to the private sector, right? So there were more and more, I think in the end, it was 70-80% of all AI PhDs were ending up and in private corporations, even before OpenAI came up with ChatGPT.
And with the last one, a non-technical person can definitely understand that because we all understand what a PhD is. But the other ones, like how much do you actually really need to understand about technology to essentially apply those frameworks to your investment decision making?
I would say the earlier you're in there, the more you have to understand it. So, for example, today, understanding quantum computing and the trajectory is extremely difficult because you have to spend a lot of time reading scientific papers and very detailed and very technical analyses. As soon as there is, an early breakthrough moment, like, for example, ChatGPT, even, an investor who has no background in technology, if they apply strategically and systematically a framework, they really have possibility to get into those technologies. And I would say that the age of tech investing has actually made it easier for non-experts to benefit from those tech waves from corporations than it has been previously in the 20th century, where you had to go deep down into technical and mathematical analysis of stocks and so on. Now it's more the bigger picture thinking, right? So it's very tough. It's very difficult to figure it out, but you don't have to be a tech genius or somebody who's very, very deep in one technology. Actually, it's better if you have range, if you understand how mass psychology is working, if you understand how tech trajectories of working if you like your head about supply chains. But as I said, on a very strategic level, you don't have to be a coder yourself to understand what is the best direction. In fact, I would say that metaverse is the best idea, that being too deep into the details can make you subject to tunnel vision, can make you it can force you to make errors that you wouldn't have made if you were a much broader range investor, right? So Mark Zuckerberg, the best idea, he's obviously a visionary because he wouldn't have been right with Facebook and WhatsApp and Instagram. But he wanted the metaverse to work out. He was so in this idea, and he said, wouldn't it be perfect if this was the next platform instead of the smartphone? And then if you're just thinking along these lines, you stop looking at the world outside of you, and it's very difficult to get a neutral assessment of a technology.
And it's interesting what you said about user psychology and that kind of adoption cycle, because it actually made me think of a company that I'm an advisor to, and it's a fashion tech company. And essentially what they do is they scan the internet to work out the next fashion trend, but not the next one like tomorrow, but the one that's going to come in 3 years' time. And then they can essentially sell that information to brands and retailers and say that, okay, in 3 years' time, this is the shade of blue that everybody's going to want, which means that, okay, manufacturers need to start making that shade of blue. And if you get that right, then, okay, if you've got the exact perfect blue handbag at that particular time, then you sell out. And the way they do it is they figure out how to spot a super early adopter, because, there are the super early adopters who are the kind of very, very weird looking fashion forward people, who dress in a way that normal people would never dress. And then there comes kind of a different wave of people who take what the very fashion forward people are wearing and tone it down. And, maybe instead of wearing a full on tartan outfit, they'll have a tartan scarf, for example. And so essentially this company, their secret sauce is being able to figure out when does a trend go from just the super weirdo, highly fashionable people, like when does it go to mass market? And also they predict when do they think that the mass market is going to tire of it and move on to the next thing. And I've worked with them quite closely, and I've seen essentially how they figure this out. And this is, I mean, there's a data science PhD there. There are some very serious mathematicians. And so when you're saying that, okay, you don't need to be a coder to figure this out, but you just need to look at this adoption. When I'm literally working with this company and there are some really serious mathematicians there figuring this out. So how do we as non-technical people do it?
That's an excellent point. So what you're describing is that they are trying to pinpoint the tipping point, right? And it's very, very difficult to forecast this. So it's almost impossible, or at least for a layperson or for a non-expert, it would have been impossible to forecast ChatGPT. Actually, even for experts. And there's a great study I quote in my book done by McKinsey, who have interviewed experts pre and post ChatGPT about their expectations when AI will actually hit the market. And most of them said, things like natural language understanding and translation and all of those things, they would come sometimes in the 2040s, 2050s. And that along comes ChatGPT, and they have revised this by like 20 years. And each one of them, right? So there seems to be, so it's very, very difficult to really pinpoint at this point in time. That's why I said earlier, getting into those super early technologies, even much, much more difficult. And of course, you don't get the same benefit when you're a little bit later to the party, or the same upside, but at the same time, you're limiting your downside. And I think that's the critical thing for retail investors, because should try to get the jackpot, right? It's almost impossible to make two bets and get Nvidia and Palantir right? So that's not happening. What you have to do is basically get this point in time where there is still a huge upside, but where the downside is limited or strongly limited. So I think that's really the goal of every tech investor. And also, being too early might be very tricky, because if you're too early, that means maybe you take 5 years or 10 years in order to really get the returns that you were seeking. Just ask any AI investor who's been in the space since the early 2000s, right? So they have waited 15, 20 years until, until really this steep growth curve comes. That's why I think it's not about getting the tipping point, but getting the sweet spot where the risk and the reward ratio are best positioned for just regular investors like us.
This actually reminds me of an episode we had recently with a growth investor who was talking about the differences between what she does versus an early stage venture capitalist. Because an early stage venture capitalist, yes, they have massive upside, but also very high likelihood that none of it is going to work out. At her end, it was okay, well, the company is actually already pretty established. And now it's just a question of scale, which, yes, means that there is upside, but it's not at the same level, but the downside is also capped. But Igor, I don't think we can really talk about tech investing and catching the next trend and discuss AI without mentioning the bubble. So, what are your thoughts on the AI bubble? Is it coming? Is it here? Has it already passed and we just didn't notice?
Yeah, that's definitely the question keeping up at night all of the decision makers, investors, and pretty much everybody else. And actually, we will only see if it really is or was a bubble once if it pops. But I think we can do very well to compare it to previous bubbles to see, are there similarities? And even if it is a bubble, the question is then more important, I believe, of how bad will it be? And of course, what comes to mind is the dot-com bubble, because we are seeing so many similarities. And I like to look at those things through the prism of those tech cycles that we're discussing. And if you do so, you will see that those two eras, right, pre-dot-com bubble burst and today's AI, they resemble each other in all ways but one. But that difference is critical. So just to give you a brief rundown through the parallels. So on the one hand, we have two technologies that promise extreme productivity that are not just transversal technologies, but they're what we call general purpose technologies, meaning that they basically transform radically every sector of the economy. And they are platform businesses, so they foster also very or promise very profitable business models. We also see a lot of parallels in terms of the hype. We see a lot of parallels also in the overvaluation of companies. If you look at P2E ratios, the P2E ratios of tech companies as compared to
and that's price
to earnings, right? So that's the willingness of investors to overpay for a company as compared to what it's worth on paper. So the relationship of P2E ratios to general GDP is roughly the same as it was a pre-dot-com bust levels. So there's certainly the same amount of hype. What we're now seeing also is parallels coming up in the financing of the AI investments, because in the dot-com era, there was a lot of circular financing, which means, for example, the telecommunication providers would, buy each other's fiber, buy each other's networks and so on. So they would artificially inflate their revenues. And we're seeing now, for example, chip makers that are buying equities or buying stakes in LLM producers. But those LLM producers, so large language models, those are the guys that are doing the big algorithms. For this equity deal, they have to buy chips. So it's kind of, again, a circular financing that obfuscates the real need and the real market. So there's a lot of parallels. I, however, believe that they are fundamentally different in one regard. And that's if you look at a concept called techno-economic paradigm. So every 50 to 60 years, there's a paradigmatic change in the economy. We'll think of the age of electricity, before that, the age of steam, or the age of oil and gas. And since the 1970s, we're in the age of information, right? With the first Intel chip coming out, then internet and so on. And within each of those techno-economic paradigms, we have a bundle of transformational technologies. But the interesting thing is that each of those paradigms is split in two big phases. One is the installation period, and the second is the deployment. And in the installation period, it's all very dynamic. It's unclear how companies are making money, or there's a lot of failures in the corporate world. But at the end of this installation period, there is a big crash, and that's happening in every of those paradigms. There's a big market collapse. A lot of players go out of business. A lot of value is shed, and it takes quite a long time to return, actually, for those companies that have been driving the change. But when they return, they outperform. Now, we had that crash in the dot-com bubble, and it was actually a productive crash because it left behind all of this infrastructure. And of course, you were able to build this infrastructure because of the hype. So what we have today is a fundamentally different tech and IT ecosystem than what we had in the 90s. So we don't have anymore some kind of startups that live only of promises and so on, but we have big tech giants. We have actually the biggest companies we have seen in the history, companies that are bigger than in terms of market cap than all but two countries in the world. So this is significant. And they are most of the investments they're financing from their free cash flows, which means that the risk is not as big. So even if there is a downturn in valuations, it will certainly not ripple across the economy as the dot-com bust has been done, because after all, you know it, after 2000, it took about 15 years for many of those companies that survived to get back to the levels they were. But again, at the same time, you had companies like Amazon that 1,000 times and more in values. It's really a big crash, and now we might see smaller crashes, but I think even if we do, it will be nothing as compared to the dot-com bust. And also, there's quite some encouraging developments if you look at how much those companies are investing in AI and that they're actually already gaining revenues. If you look at Google, about 20+% of their cloud revenues are actually by AI solutions. The same Microsoft is also earning quite a significant portion. So those ratios of investment to revenues from AI, they are improving, right? They're still high, but they're improving, which is a very healthy sign. It's a sign of a very healthy trajectory. So there might be crashes coming, but it will certainly not be as bad as we have seen from bubbles in the past.
That's a really interesting comparison. Thank you very much, Igor. So if people want to learn about these frameworks and how to spot the next tech investing trend or how to evaluate what's in front of them, where can they find out more?
So yeah, definitely. I did spend quite a lot of time thinking about those things and researching. And I wrote it down in my new book that's coming out in May. It's called Tech Money, how the age of technology is changing the rules of investing. You can find it basically at every big retailer. And while you're at it, I'm also running a pre-order campaign, giving out a free online course on tech investing for everybody who does pre-order the book and gets in touch. So now it's the best time to get your copy and make sure that you're kind of using those opportunities that the world of tech is offering.
Awesome. Thank you, Igor. And actually, I just thought of one last question I want to ask you before I let you go. If somebody is evaluating an opportunity to invest in, but they're not just going to hand their money to it, they actually are thinking, well, I'm going to not only invest my money, but I'm actually going to do it. Like I'm thinking, should I go and create this product and start this venture? Would the same frameworks apply?
Great questions. And yes, because I'm always asked, what is a defining characteristic of a successful company? It doesn't matter whether it's a startup or whether it is one of those tech giants. It's always that the company is riding on the wave of a successful technology, right? iPhone was so successful, the most successful product in history, because it was riding the wave of mobile. Of course, ChatGPT with Gen AI, and I could go on and on and on. And of course, if you're a startup, you will probably not create a large language model. But even if you're, let's say, in cryptography, and post-quantum cryptography is now coming up, that is the major indicator of whether you are on the right track. And there's many of those models in the book, and many of those text titles. I think it's definitely applicable not just to public investors, but also to managers and founders.
Awesome. Well, we will link that in the show notes. On that note, thank you very much for joining us, Igor, and have a wonderful day.
Thank you for having me.